In this video, I'd like to talk about what a home equity line of credit is and to give you an example of how you would go about computing what your line of credit might be based on your level of home equity. So if you had a home equity, let's say that the fair market value of your home, you just had it appraised and it was worth $135,000, but you still had a balance due on your mortgage, your first mortgage, you owed $40,000. Now, if we were going to compute your home equity, it would be $95,000, right? So this is the claim here that your lender has on your home, and then this is the residual value, the equity that you have in the home. And the idea of home equity lending is that you can go and you can tap into this as a source of credit. So you can almost use your home as a piggy bank of sorts. Now there's two ways that you can do this, and one is that you can just get a straight up loan at a fixed interest rate and just say, okay, let's say you end up getting a $70,000 loan or something, and then you use that to pay college tuition for your kid or something like that. It's just a lump sum in terms of the loan. Another way of doing it, instead of a lump sum, is you could tap into this source of credit and say, what I want is a line of credit. I want a line of credit. And if you don't know what a line of credit is, let's just say that you got $60,000 line of credit based on what your home equity is, and then it's saying that your lender's not just going to give you a lump sum of $60,000. They're saying, okay, we've given you this line of credit. That means at any point you can borrow up to $60,000. Right? You can borrow up to that amount. You don't have to borrow the whole amount. We're not going to give it to you all right now. But if you say, look, I need $5,000 to buy a new car for my kid, you can go ahead and draw down on $5,000 of that $60,000. And usually there's like a term limit or something. It's like, okay, every 10 years it comes up and the lender gets to decide whether or not they want to continue giving you that line of credit. So it's not like just a permanent loan so you get this revolving line of credit that you can just tap into as you need it. And so I've already talked about regular fixed rate home equity loans in a previous video. So this video, I just want to focus on the home equity line of credit. So how would you go about determining how big your line of credit is? In the example that we gave above, we have home equity of $95,000, but that doesn't necessarily mean that you're going to be able to get a revolving credit limit of $95,000, right? Because the lender wants to protect themselves, and they might say, you know, it'd be risky to just lend you this whole amount. They might do that and charge you a higher interest rate, but in a lot of cases, they're going to give you a percentage of that. So you would go about calculating it in a very similar way to just a home equity loan. For a lot of lenders, you would start with the fair market value of the home, and then they would have some percentage rate. Could be 75%, could be 80%. In this case, we'll just say it's 80%. And so the lender is going to take 80% of the fair market value of your home, and that's going to be, in this case, $108,000, right? I just took the $135,000 the home is worth, and then took the lender's rate of 80%, which I said, you know, this will vary by lender. So this is vary by lender. So you want to check with your lender. So that's going to give us a subtotal $108,000. But now we're going to deduct the balance due. And when I talk about the balance due, I'm talking about the principal, the remaining principal that you have on your loan. Okay, the amount that you still have left to pay off this loan. In this case, in the example we gave above, it was $40,000. That's what you still owe the lender on your first mortgage, right? Now you take that and you deduct it. I've got in parentheses to indicate I'm subtracting it, and that's going to give us $68,000. So in this example, this would be our home equity line of credit. So line of credit. $68,000. So again, now what I want to emphasize is this is not a lump sum. This is not like that means they're just going to give you $68,000 and say, okay, pay it back 15 years from now. It's a line of credit. You can tap into it, let's say anytime in the next 5 years, in the next 10 years. You work that out with your lender, whatever the term is. But at any point up until that time, you can tap into up to $68,000. And of course, you're going to incur interest on this. This isn't interest-free or something like that. There's going to be an interest rate that you will incur, and there'll also be, like, you might have other types of things. You might have an inactivity fee. So an inactivity fee, you say, well, what's that? Well, if you don't tap into any of the credit for a couple of years, the lender says, well, we're going to charge you $1,000 anyways. You didn't use this. There's some kind of inactivity fee. And then also there's other fees too, just home equity loans in general. You're going to have to pay an appraisal cost so that they can figure out that the fair market value of your home is $135,000. So there's fees associated with this, above and beyond just the fact that you're going to have to pay an interest rate on this. And so because you're paying an interest rate on this, it's important to remember this is a second mortgage. So this is a second mortgage. And so you might be saying, hey, wait, can I deduct the interest from this? Because again, it is a mortgage. Well, yes, in certain circumstances, the IRS has determined that you can. So first off, we have to take a look at that line of credit and look at the size of it. And if it's less than $100,000, assuming you're married filing joint for your tax status, then the interest may be deductible. And when I talk about deductible, I'm talking about if you itemize, just like the interest on your first mortgage. Now, it would have to be less than $50,000 if your filing status is married filing separately. So, but there's also another condition, and that is that the line of credit needs to be less than the fair market value of your home, and that being reduced by the home acquisition debt, which technically what that means is your first mortgage, right? So you already have debt, you already borrowed money to buy the home, and so you're going to reduce the fair market value of the home by that. If that amount is greater than the line of credit, then to the extent that it is, you might not be able to deduct the interest for your line of credit. So you might be wondering, well, why would somebody do this? Is this something that is risky behavior? Is it something that, no, this is a wonderful idea, everybody should be doing it? Well, it depends on what your situation is. So now if you have credit cards or something like that, and you have these credit cards and they have a very high rate of interest that you're being charged, then it might be advantageous. You say, you know what? I want to dip into this line of credit. I'm going to take $10,000 maybe out of this, and I'm going to put it toward my credit card debt, pay down these credit cards, because the credit cards might have a much higher rate of interest than you'd be getting on this second mortgage. Right? On your revolving credit line, you might be paying 5%, where maybe the credit cards you're paying 22%. You say, you know what, I'm just going to take this money and then I'm going to pay it down toward the credit card balance. Or maybe you'd like to make some major repairs to the home. You want to pay tuition for your kid. You're buying your kid his or her first car. So you're basically getting the chance to tap into the equity in your home and use it as a line of credit that is there as a convenience to you whenever you need it. But bear in mind that by doing this, you are reducing the equity in your home. Right? Because you're borrowing against this equity that you built up. You built up this equity, so now you're reducing the equity because now you're borrowing against it. And you might say, well, what does that mean? What do I care? Well, the very important implication of that is if you don't make your payments, if you don't make your payments on this second mortgage, you could actually lose your home. So it's not something to take lightly, but it is an important kind of option that you have and a benefit of home ownership. As you pay down the principal and so forth and build equity in your home, you have this kind of nest egg that you could tap into possibly if you were to be able to get approved, if you're credit worthy enough and you find a lender that would give you a line of credit.